Scott Olson, good to see you, my friend, Executive Director of CHLA. How are you?
Good morning. Good to see you.
Yeah, well, wish we were talking on more exciting terms, but I have you on here today to talk about the passing of your old colleague, Barney Frank, who was pivotal in helping to shape the post-financial crisis and ensuring that we didn't have another crash, which we've not had since he helped to put in the CFPB and, of course, co-author Dodd-Frank. Tell us how you came to work with Barney Frank and what you remember about that time.
So I started working actually for the subcommittee or the committee about 6 years before for two previous members. And then when he took over in 2003, he became my boss. And the first thing, oh, by the way, thank you very much for having me on. For all of us that worked for him, I think we have to sort of collectively work through some sort of therapy by talking about this because it's difficult to deal with. So I appreciate your having me on. Number one, I think everyone really respected his intellect and his commitment to the things he believed in. He was not like a lot of present day people whose first goal is, how can I get press? I mean, he really didn't actually care about press. He just, at the end of the day, he tallied up what changes he was able to make. And he taught me, I can't tell you how many times I've been in meetings where people will say, well, you can't do that because the law doesn't. And he goes, we are the law. If it's a mistake, we can fix it. And that's the way he looked at everything. He always thought you can always make things better. So that's what he was about. And he was a great boss to work with. He kind of had a reputation of being tough on people, and he was. I mean, he yelled at me there. If he didn't ever get mad at someone, then they weren't really doing anything for him. But he's the only boss I've had out of 4 members of Congress that actually wrote me a personal note thanking me for the work I'd done on a deal. And you really can't ask for more than that, to have a boss that criticizes when you screw up and compliments you when you do a good job. To me, that's about as good as it gets.
Talk to us about the great financial crisis and
Sure.
his role and impact there, and what it was like to work that through with him.
Sure. Obviously, a lot of people have watched documentaries and shows about how serious it was, but I think it was more serious than these shows implicate, which is we were in a free fall and the economy was cratering. People were getting fired. The mortgage market was in a meltdown. And in the middle of that, the concern was that the large financial institutions, the big banks, and particularly the Wall Street banks like Goldman and those people, would go under because Lehman Brothers went under. And if that had happened, it would have turned the biggest recession since the Depression into a depression. And so in the face of that, he worked with Bush Treasury Secretary Hank Paulson and Chris Dodd and other leaders in Congress to fashion a package that was vilified as, quote unquote, bailing out the big banks. But in fact, it was an effort to try to make sure they had liquidity and were going to stay in the market and make sure that credit was still being provided. And we had a really scary moment where we were voting on the bill and it failed by like 3 votes. And while it was being voted on, the stock market fell the Dow fell 700 points. But Barney and a lot of other people stuck with it, came back, and 3 weeks later got it passed. And we survived, and we've had a pretty good run, once we recovered a few years later. So I think that's the most significant thing he did. Politically, the people that voted for that bill took a lot of heat. Some got thrown out of office, but it was the right thing to do, and we're all better for it.
It's not perfect, Dodd-Frank. And he even came back around and tried to make some changes years later. Mm-hmm. One change that the mortgage industry has been trying to make that came from this bill is it a bill? Would you call it a bill?
Yeah, it was a major
law. It's law now. It was a bill that's now law. That's how we would describe it, right? So
exactly.
Is loan officer compensation.
Yeah. So, this is actually one of the things that I'm not sure I see eye to eye with my ex boss. I mean, this was designed to address a real problem, which was that aggregators are offering to pay brokers more money if they could give them a worse deal for the consumers, and that was bad. And it was appropriate to eliminate that. But the way the bill's been implemented since it passed is to extend to internal compensation. And at CHLA, that's been our main point: is that that's unprecedented. It's actually not even, depending on how you read the bill, it's not even necessary. But it's based on, I think, an outdated premise that everyone should get the same deal. And the only way to do that is to make sure that every LO gets paid the same amount on every deal. And I think that's been overtaken by events. I mean, you can shop for loans, you have TRID, you have all these things that I think have rendered that consumer protection out of date. And so we're saying, let's get back to saying you can't do what the bad things that happen with the brokers being incentivized to bring bad deals, but within a firm, we shouldn't be regulating compensation. So that was the one thing that I think we ought to change. The other thing was that we, as an IMB, I feel like the SAFE Act passed in 2008, and it exempted banks, and we don't understand. In Dodd-Frank, we had a provision that said that all loan originators should be qualified. And every year I used to go out and call the CSBS, and they'd say, there's 2,000 people that failed the SAFE Act test and are registered as a bank. And so we don't understand, we've been saying for over a decade, we don't understand why you just don't level the field, make everyone pass the SAFE Act test. So there's a few things that I think need fixing. But let's go back to what we did do. Dodd-Frank, the no-doc loans were horrific, and they helped cause the crisis. And QM, I know it's been criticized at various levels, and we're still working out the details, but it's prevented people from going off the deep end, and it's made sure that we have sound underwriting. And I think that's an accomplishment.
If Dodd-Frank never happened, how would that have changed history?
I think that the purpose of Dodd-Frank, because you go back and forth between crisis and then reaction with more regulation, is I think some of the things. The other thing I wanted to say about Dodd-Frank is the FSOC, which is, again, it's been criticized, but it's basically too big to fail. The idea that we learned with Lehman that there ought to be advanced planning to make sure that if major institutions go out of business, that the economy doesn't collapse. And I think those sorts of things, that and the QM, if we hadn't had these guardrails, I think we would have been at an increased risk of having a frothy market and go off the deep end again. And I think it's good for the industry to have more stability. And so, do you always get it right in that balancing? No, but I think the guardrails are really important for the long run health of the industry.
So the detractors will say that he was blamed by conservatives for resisting tighter regulation of Fannie and Freddie in the years leading up to 2008. And so some people feel like maybe he contributed in some way and then came in with his fire hose to put the fire out. I read that yesterday.
That's just categorically false.
Yep.
It was the Bush administration that dramatically increased housing goals. Honestly, 5 days before the 2004 election, that was a contributing factor to Fannie and Freddie going off the deep end. And so I think there was, a bipartisan failure.
It's an unfair characterization, you're saying. How about this? Reputation for being prickly, condescending, combative. The 2009 What Planet did you spend most of your time on? Town hall moment in the in that one clip. What was he really like as a human being? Did you become close with him, or was it more of a collegial relationship?
I think it was I know that he had close relationships with some people that he worked with. I mean, I didn't. I mean, I had an excellent relationship, but we weren't like friends. And he was tough. And I could tell you stories. He just wasn't someone that suffered small talk. And, I could tell you a stream of stories where he just wanted to get things done. So people would come into the office and try to be polite and talk about a conversation. And he said, okay, what are you here to talk about? So
he's very direct and to the point. What's your best Barney Frank? What's your best Barney Frank story that really embodies the essence of him?
The best story. God, I don't know. It's just it's a collage of things, but I think that basically he did not suffer fools well. And you read a quote. I'm sure if you spent another day, you could find 20 of them where he skewered people. And so I think that is the essence. He just didn't suffer fools very well. But if he thought that you were serious, whether you were a Republican or whatever, he took you pretty seriously and he treated you with respect.
He crossed the aisle well, didn't he, when it mattered
did.
most?
He was always willing to work with other people. He basically wanted to get what he could. In other words, today we have people that it's almost like they don't want to succeed. They want to push for something. And if it looks like they're going to get it, then they push harder because they want the issue. And Barney never wanted the issue politically. He always wanted whatever progress you could make. So we had, there was a member on the committee, Representative Gary Miller who was a Republican from San Bernardino. He worked closely with him on housing issues. And for example, we were putting together the Housing Trust Fund, which was a groundbreaking affordable housing bill. And he said, we're going to make this open to for-profits. And I said, Barney, you can't do that. All the housing groups are going to go nuts. And he said, he looked at me, he said, I'm the boss here. We're going to do that. And he did it because he was building Republican support. Gary Miller, who led the effort, and other people to get the bill across the line. Dodd-Frank, he had to get like 3 Republicans in the Senate to vote for it, or it wouldn't have passed. So he was always figuring out, obviously, if he could get something done with just the Democrats, he would do it. But he was always figuring out what's the most I can get. And I'm happy to work with Republicans. So I think that's kind of unusual today. I think it's very.
Yeah, he was certainly a great negotiator who knew when the moment was ripe to take what you can get and go on your way. Any final thoughts or words about how the mortgage industry should remember the co-author of Dodd-Frank?
Sure. I think that the issues of the balance going back, Dodd-Frank, back and forth between regulation and no regulation, we have to get it right. Okay. And I understand the industry feels like we went too far in that direction of regulation. So fine, fix it, move it back, but you need guardrails. And I think that's the center of, he believed in capitalism. And so we got to have a thriving mortgage industry, but there have to be appropriate guardrails and they have to be efficient. And that's the memory, I think, of what he was trying to accomplish in that way.
What should he be remembered for? What is the legacy that he leaves behind in your eyes as someone that worked closely with him during the most tumultuous time in our nation's history?
Well, I think personally, if he were answering this, it would be he was a trailblazer in terms of being like the first gay member of Congress really to go public and to fight for gay rights. But I think it's, I would close by saying next month the book is coming out. He's been on the lecture circuit. He's basically criticizing Democrats for being too pure and for trying too hard to say, if you're not with us on 100%, you're not with us. And I think that's the message that he was taking to his grave. He was very sick and he was out doing public interviews to make that message, which is that, fight for something that's reasonable. Don't make this a political circus. And I think that's clearly where he's always been, but increasingly at the end of his life, that's what he was turning to.
Let me go off script here. Thank you for all of that. Really appreciate that. There's a question that has been asked a lot lately by people I know in the mortgage industry. I'm hearing this question so often now, and it pertains to the war and what we're seeing with the 10-year yield and oil prices and inflation. And people are asking me, I'm no economist, I don't even know how to answer it. Like what needs to happen for this to stop? Do you have an opinion about that? And what's the likelihood, whatever your opinion is, will occur?
I have an opinion, but it's not short term, it's long term, which is that I'm one of the old timers that believes we can't keep running the kind of deficits we are, that with kids in my 20s, I'm concerned that the day will come, if we don't start getting our fiscal house in order, when people overseas are going to stop buying our bonds and rates are going to skyrocket and our economy is going to crater. So I think you're asking an intermediate question, which is on the minds of everyone. But I think that, unfortunately, like we saw in the 70s, that if you have these external factors like this, you have no running room and the Fed can't do anything about it. So I think and both parties have given up. The Democrats have stopped talking about increasing taxes. The Republicans have stopped talking about cutting spending, and no one's out there talking about how to close the deficit. And we have a Social Security is going to run out of money in 7 years. I think those are the issues that are absolutely critical to our economy. And I understand why you're asking the question about the next 6 months, but I think we have a much more serious intermediate crisis.
I appreciate that. Let me ask you a different way to just focus, if you would, on this particular moment. I love what you just told me, by the way. I'm going to definitely use that and repurpose that, because that is the broader picture that we certainly need to look at. And there's a lot to unpack there. But as it relates to this moment right now and what you're seeing, you've got CHLA, Community Home Lenders of America, growing. NFM Lending is a member, a proud member, I might add. We love the impact that CHLA has made and the seat that we really, really have at the table. Obviously, people are seeing you now and hearing just how much knowledge and brilliance you have, and that all gets displayed on the daily in the CHLA if you're a member too. So I'll just throw that little plug in there.
Thank you.
But I'm one of your clients, right? And your trade group, you represent the industry, and so what level of concern should I have as a client for the fact that right now we're at 7% and potentially climbing?
So I think that the problem is, I think the problem is, how come prices haven't come down? Theory should be that when rates went from 3.25% for 30-year mortgages to 6.5%, that prices should have adjusted, and they haven't. So that's made things unaffordable. We've lost the refi market. And so where's the business? Who are buying homes? And so that's why we held an event the other day about Gen Z home ownership, because if young people aren't getting into the market and they can't afford the homes that are buying, then our industry is going to suffer. And so I think that's, I don't have an answer. I don't think that we should sit around and fool ourselves that it's going to go to 4.5%. I think that the industry's gone through a really difficult period of adjusting to the loss of refis, and we just have to industry seems to me to have to slug it out. We're doing the best we can to try to make the regulatory environment better, to try to promote products that work for buyers. But I think we need to focus in on affordability and, like you say, consumers. Exactly. If we don't have a healthy environment for buying homes, then our industry is going to struggle. And so I think as an industry, we need to spend more time focusing on
well,
that.
the data suggests that renting makes a lot more sense in many areas in the country right now, that it just costs way too much to buy a house between the down payment and the payment, taxes, insurance, all of that stuff, higher rates. So that's a problem. And, I thought about it this morning, like, what would I tell my kid right now who would approach me and say, "Hey, Dad, I think I want to buy a house"? My message to him would be probably hold off for now. We could be on our way down in terms of values. And certainly there's just too much going on right now to take on something that might not be an appreciating asset for the next 3 to 5 years. What would you tell your kid at the moment? Keeping it raw and real,
Well, I think that, the number one, people that have families are still going to desperately want to buy homes. It's hard to raise a kid in a 2-bedroom apartment. But I think you're right. I think that we need to build more housing is the only answer. So that's why I come back to the fundamentals. if the prices haven't gone down, but the rates are higher, it's going to be harder for people to afford homes. And unless we address that and get that equilibrium back, it's going to be a difficult thing. There's a lot going on. There's states that are now talking about zoning by right, and people are talking about more density and ways to get more affordable housing. At CHLA, we really focused on things like condos and manufactured homes because that's where first-time home buyers can afford them. But I think it's going to be all of the above.
Yeah. One thing that I think is a deterrent, I'd love your opinion on, and then we can wrap this up. I know I told you 10 or 15 minutes, but you're Scott Olson. I got to keep you on as long as I can.
Thanks.
The $10,000 interest cap on your primary residence, it used to be unlimited or much higher. And so, you can only write off 10% of your interest, or I'm sorry, $10,000 of your interest. And that is a deterrent in my eyes. Also LLPAs and G fees, like particular LLPAs. Is there any hope? Do you have any hope? And are you at CHLA working on any scenarios where maybe we could get a temporary reprieve on that $10,000 cap, or get a 6-month, 12-month window where LLPAs are diminished greatly or eliminated for a period of time?
So on the tax, I mean, you're talking about tax front, which is really difficult process. I think there's things we could do. We could talk about, for example, we've talked about a tax credit, a mortgage, an annual tax credit for those people that don't itemize, who no longer have any tax benefits. But CHLAs, the LLPAs are too high, and we've been, there's no reason for an LLPA for the condos. The high cost areas, it's outrageous. They've priced them out of the market versus jumbos in a lot of ways. And these are done for reasons that escape me. And so the FHFA is said to be close to making changes to LLPAs. We've been advocating for what we want, but that's a really important first start. And I think you're right. If you could do something on it, you're suggesting doing something on a temporary basis. That makes a lot of sense.
Well, because, and I've said this a lot recently, like Fannie and Freddie were not designed to be cash cows. They just weren't. Like if you go back and look at the bylaws and all those things when they were set up, they were just there to provide stability to the market. And if they broke even, great. They were going to help promote home ownership, put people in houses. Fine. It's not like that anymore. Cool. No problem. Right? Like, okay, now you're cash cows. Now you're taking that money, you're moving it into Treasury and all these other places to help, keep the deficit down as much as you can, which obviously isn't a lot. But that's cool. No problem. Like we should all just come to terms that these are now for-profit moneymakers. No problem. But if that's the case, why not use them for levers? Use them for levers. And this is a lever moment right here. We have an election coming up. Very important. The Republicans appear to be losing their grasp. And this is a lever that they can pull to promote affordability, which is the number one issue, I think, for day-to-day Americans. I'm not talking about the upper crust. So a 6-month reprieve, a sunset on capital gains for 2 years, which is an idea Mark Calabria shared with me, the former FHFA director, once upon a time. Like do something.
Well, we have a proposal that says if you sell, like if you're a parent and you'll get some capital gains relief if you give the money to your kids to buy a home, something like that. Access a lot of down payment. But
something like that.
I wanted to talk about the LLPAs because you said, well, they're for-profits. Well, they're not operating as a for-profit. In the high-cost loan areas, this is designed to discourage lenders from making $880,000 loans in California or Washington, D.C. or New York City area, which are starter homes, in some cases falling apart. And it's ridiculous that we charge such exorbitant fees, and that's because they want to discourage those loans. If they were a for-profit, they wouldn't be doing that. They would be cutting their fees in that area. So, I mean,
you say that, but Scott, what are they making a year? 17?
No, I'm saying they're making less money with the higher fees than they could have in some ways because they're not making these loans.
yet they're making billions upon billions of dollars. They're
They
not
are
supposed to
making
be.
billions.
So I mean, they're not. They're certainly. No one is going to cry a river.
Yeah,
My point is, cool. You want to make money. This has taken on a different shape than originally. I mean, things change a lot in a lot of ways. Use it to your advantage. Make a little bit less for a period of time until you restable. To me, that's stimulus for housing. That's real life stimulus. It's a lever they can pull right now. And then when they get things back on good footing and we close the affordability gap, push the lever back and make your money.
Well, so Greg, we'll give another idea. FHA makes like $8 billion a year in profits for taxpayers. Okay. They have their fund right now is enormous. Why not do a 1-year holiday on premiums for first-time home buyers?
Yeah, I like that. What about the MBA's idea, which Bob Brooksmith has hinted at, and I've talked to Pete Mills and others within the Mortgage Bankers Association about this, and that is for that surplus. You're talking about the fund being close to 6 times the statutory requirement. And so the MBA has gone to them, and I believe they've said to the MBA, well, look, we have increasing delinquencies. We're probably going to hang on to this money. And Bob has said that, well, what if we tighten the credit box at the lower end, in exchange for maybe lowering monthly premiums? Do you have a position on that? What do you think about that idea?
I don't think we need to tighten the credit box. Look, I mean, the whole idea is, why did you build up this enormous surplus if you can't use it? It's like if you spent $5 or $10 billion, their resources would still be huge. So I don't think we need to tighten. As I said, some sort of holiday makes sense. Now it's complicated politically, but it's what we ought to do. So
I appreciate your time. It sounds like someone might be in the kitchen right now.
Oh, I'm sorry.
Something up.
That's all right. I guess it's breakfast.
No, it's making me hungry.
You can smell that? You can smell it.
I can, from all the way over here in McLean, Virginia.
Okay.
Scott Olson, Executive Director of Community Home Lenders of America. Really appreciate your time and reflection on the late Barney Frank.
Love to be back anytime, Craig.
All right. You're pretty good at this, by the way.
Okay.
FYI, in case you didn't know, we definitely have to do this again. Enjoy your breakfast.
Okay. Thank you, Greg. Take care.
All right. So long. Bye-bye.
Bye.